Great job, everyone! We're diving into small business finance, finance for small businesses. I hope you found this video valuable. Ideally, your small business financial plan will contain key statements and projections or forecasts that help inform the actions of the business. Using accounting software can help make your financial planning and record keeping more effective and less time consuming. When you need to apply for funding, you can reduce the legwork of having to recreate all of these statements for your application. In fact, with FundThrough, you don't need to submit any of these statements at all, as our app simply integrates with your invoicing software. Small business borrowing, how-to and planning questions. What is cash flow? Cash flow is the lifeblood of your business. It's the measure of how much money is flowing into your business versus the amount flowing out over any given period, and without it, your company can't meet its financial obligations. You can learn more in the Ultimate Cash Flow Guide. How does cash flow factor into our business planning? If you're wondering, is cash flow forecasting part of a business plan? The answer is yes. Negative cash flow is the #1 reason businesses fail. If there's one place you're going to focus your energies, this is it. Cash flow statements are a critical tool as you grow your business to show you exactly where you stand at any given point. Cash flow forecasting will help you foresee any potential gaps before they happen, so you can proactively put cash flow tools to work. What is a cash debt coverage ratio? Your cash debt ratio is the measure of net cash from operating activities versus your average current liabilities. This tells you whether your operations can support payment of your current liabilities. The cash debt coverage ratio formula is current cash debt coverage ratio equals net cash from operating activities / average current liabilities. How do you get approved for a business loan? If you don't have all of those things, it can be challenging to impossible to get approved for a business loan. Many owners turn to private lenders, investors, or VC firms next, but this can mean giving up equity in their company or having to agree to high interest rates and unfavorable loan terms. That's why so many entrepreneurs and small businesses are choosing to use more creative sources of funding that allow them to bootstrap their own businesses. One way you can do this is by making better use of your accounts receivable through invoice factoring. Here's how it works. What is the difference between secured and unsecured financing? Secured financing means the borrower has used an asset of some sort as collateral. This can be a risky strategy. Imagine using a large piece of business equipment as collateral, then losing a major contract that caused you to default on your loan. Your ability to do business at all could be limited or even eliminated. Sometimes banks ask small business owners to use personal property such as a home or retirement savings as collateral as well. The risks involved are too great for many owners to stomach, which is why more are turning to innovative new alternative financing solutions like invoice factoring, which advances funds you've already earned rather than creating new debt. Capital injection versus loan, what's the difference? A capital injection is an investment in your business that gives you operating capital. A loan is just one method of injecting capital into your business. Other methods include owner investments, VC funding, and invoice factoring. How can I quickly establish credit for my new business? Traditional lenders like banks want to see an established credit record before they'll even consider lending funds to a business. The best way to establish credit is to carry at least 2 revolving credit products, such as a credit card and line of credit, and to not only use them regularly, but pay down the balance each month as well. While you establish your company's credit, you could use a cash flow tool like invoice factoring to speed up your accounts receivable and free up funds to grow your business. How important is it to be proactive in small business financial management? It's critical. You can't just set it and forget it with your small business finances. Run important financial reports, including your balance sheet and cash flow statement regularly, and use a cash flow forecasting tool to get ahead of any potential gaps in cash flow. Considering that negative cash flow is the #1 killer of small businesses, cash flow forecasting and management are the most important aspects of your financial management activities. How do small businesses find alternative funding? Well, you're in the right place and already have a head start. Invoice factoring is one of the best ways to improve your cash flow while limiting risk, as you don't need to take on new debt to fund your business using this tool. Invoice factoring advances revenue you've already earned, so you don't have to wait 30 or 60 days or more to collect your invoices. You can learn more about how it works here. How do startups find funding without giving up control and ownership? Finding funding without bringing on investors or giving up equity typically requires that you make creative use of your company's assets. What assets, you ask? You're right, most small businesses don't have much in the way of assets, especially not anything they can afford to lose by using it as collateral. That's why invoice factoring has become the go-to funding tool for all kinds of businesses, from contractors to manufacturers to retailers and more. Invoice factoring puts the power of your accounts receivable to work for you by advancing your invoices. You retain full ownership and control, and because FundThrough operates in the background, your clients never know you're using an invoice factor. Check it out. Can companies get a cash advance? Absolutely, but make sure you understand all associated fees, terms and conditions, and interest. Traditionally, companies that offered invoice factoring would purchase your invoice, advance you about 80%, and go collect from your clients. There are a lot of companies out there today that operate more like payday lenders, advancing your funds but charging extremely high interest rates. Use a reputable invoice factor like FundThrough to have invoiced funds advanced to you. You pay one simple fee with no additional service fees or interest charges. Calculate the total cost of invoice funding here for free. How can I calculate the cost of a bank loan? To calculate the cost of a bank loan, you'll need to know the amount being borrowed, the length, term of the loan, and the interest rate. A simple online calculator like this one offered by Bankrate.com allows you to plug in your figures and see how much a bank loan will cost. Where can I find a business loan rates calculator? For more complex business loans, try this online calculator that allows you to choose different interest types, additional fees, repayment schedules, etc. As you can see, business loans can get complicated if you qualify. Is there an alternative to a bank loan for financing my equipment? Yes! Invoice funding is a smart, proactive alternative to bank loans that can help improve your cash flow and prevent cash flow gaps, finance new equipment or inventory, hire new talent, and more. You don't need to jump through the hoops of traditional lenders or worry about high interest charges and hidden fees either. Learn more about how invoice factoring works here. If you enjoyed this video, give it a thumbs up, share with your friends, and leave your thoughts in the comments below. Remember to subscribe and turn on those notifications.